How's it going, everyone? My name is Kenny Indiano, and this is my strategies to reduce insurance costs while maintaining quality. Section 1 is about understanding the challenges of rising insurance costs. The importance of insurance in financial security. So, number one, the important insurance in my mind here is that many companies, many individuals have assets that they must protect. And to protect those assets, they need insurance. First, here for this risk mitigation strategy, insurance acts as a financial buffer, which enables individuals and businesses to manage unexpected expenses effectively. And here on the right side, you'll see administrative inefficiencies, lack of competition, and all the different percentages of how, with an increase of these things, it would actually decrease insurance as a whole. So by decreasing insurance as a whole, this would help foster long-term financial stability and buffer up resilience against economic fluctuations. There's many different factors contributing to high insurance premiums. Impact of natural disaster, which is one of them. The increasing frequency and intensity of natural disasters such as hurricanes and wildfires have led to a surge in insurance claims, driving up premiums as insurers adjust to cover the heightened risk and potential financial losses associated with these catastrophic risks. So what most of these companies do is when they have areas where there is maybe it's a flood zone per se, they have insurance that is provided through that flood zone insurance. And when it comes to how much coverage you really can get through that, it's what the company will provide in the specific policy. Most policies will provide basic debris removal, but they will not provide coverage for things like a house's foundation. The impact of rising costs on individuals and businesses. So first we have the increased financial burden. As the economy currently, inflation is rising, as you know, and the cost of products and services is getting higher and higher. With those costs and services getting higher, insurance is one of those which is also increasing the price of premiums for many individuals and businesses, which is making it harder for large businesses to maintain their group policies, and it's making it harder for small businesses to purchase smaller group policies. Again, rising insurance premiums force individuals to allocate more of their income towards coverage. So more of their income is having to go towards the security of their income rather than towards their actual just maybe the ability to keep that income in their pockets. So there's operational challenges for SMEs, which is small and medium enterprises, face operational costs due to increased insurance premiums, limiting their capacity to hire, invest, and grow sustainably. And next, like I talked about before, we have that inflationary pressures. And above here, you'll see the charts. Cost push inflation occurs when the firm responds to rising costs by increasing their prices to profit margins. So if there's going to be an increase in labor costs and products costs, well, there's going to be also an increase in what they have to charge to the consumer. As a business passes on rising insurance costs to consumers through higher prices, this will contribute to overall inflationary trends. The need for affordable insurance solutions. Financial accessibility. Enhancing competition among insurers can lead to innovative products and lower premiums, benefiting consumers through better choices and pricing. When it comes to insurance overall as a whole, there's not much competition. You have the main brands, you have Allstate, you have Progressive, and etc. Many different main brands here that have been controlling the market, anywhere from auto insurance to home insurance or to watercraft insurance, whatever it may be. These main brands are controlling that market. But with an increase in this market, this will help boost the overall quality of insurance, and also the accessibility to those who can't afford it as well, while lowering the premiums. All right, section 2, we have effective strategies for reducing insurance costs. So, policy standardization and simplification. So, by implementing standardized insurance policies, not only simplifies the decision-making process for consumers, but also enhances their ability to compare options effectively. So, essentially, what this means is if the consumer had a way to go onto their computer, go onto their phone, basically look at many different coverages at once, and be able to compare and see which one best fits their needs, and then be able to see which one best fits their financial needs. This would help the consumer make that decision and make an informed decision at that. And this would also lead to an increased confidence within their insurance selections. Because also, usually the person who is selling the insurance, so the agent or the company, is a lot more educated, so the words or terms that they may use may not be as easy to understand to the everyday person who's not always doing this type of thing. Leveraging technology for cost efficiency. So implementing automated systems reduces manual errors and processing times, leading to significant cost savings and improved efficiency in insurance operations and customer service. We have enhanced risk assessment, which is utilizing advanced systems like AI enables to better predict risks, allowing for more accurate pricing models, and ultimately lowering costs for consumers. Yeah, the use of automation, the use of AI, it's easy. If you use these systems, you mitigate administrative costs, you mitigate the need for user error, and you also be able to cater to a consumer's needs via insurance policy. Government subsidies and price controls. Economic stability through interventions. So the government subsidies and price controls not only enhance insurance affordability, but also contribute to the overall economic stability by ensuring essential coverage remains accessible, therefore reducing financial strain on households and businesses. So as you'll see as in this graph here, it's money granted by the government to assist a business. Small businesses especially get this money because simply they need it. Simply they want to provide benefits to their employees, and this is how they can do that. Encouraging preventative care and risk mitigation, health insurance, auto insurance, homeowner insurance, life insurance, and specialty insurance. So make it the most important thing is to encourage people to get this type of care. Section 3, implementing solutions for sustainable insurance affordability. So by enhancing the market competition and consumer choice, lower premiums through competition. The increased competition will lower premiums as a whole. Diverse coverage options. With many different coverage options, this offers a variety of policies that will be offered and can be offered to a consumer. And then the transparency in the offers. You need clear communication and transparency, so the person purchasing an insurance policy can make an informed decision. Tailoring coverage for specific needs. There's customized risk assessment, there's cost-effective policy selection, and there's enhanced consumer satisfaction. Which all of these mean in summary is that by focusing on essential coverage, being able to tailor to precise evaluation for an individual and an organization's risks, and then to be able to personalize their needs for that would equal the ultimate customer satisfaction, because that policy is covering everything they need and is also in the affordability range for what they need. Regular review and adjustment of insurance policies, annual policy evaluation. Annually, companies should evaluate a policy. Did your risk go up? Did your risk go down? Do you need to get prorated? Do you need to get short-rated? These evaluations need to happen often to make sure that the producer is not taking too much money from the consumer, and the consumer is not getting too many benefits that they're not paying for by the producer.